As a small business starting out, setting a proper accounting system using journals and ledger accounts to record transactions on a regular basis, as opposed to merely writing down details on a piece of paper, will better enable you to, as an entity, to communicate economic events that will assist decision making. All transactions that occur within a trading business will initially be entered into the general journal, and from there will be entered into separate ledger accounts. The general journal can have two types of entries, either a simple entry composed of one debit and an equal credit, or a compound entry of 3 or more accounts, such as a debit and 2 credits, the amount of which will equal the debit to balance it out. For each entry, a narration should be included, which is a brief description entailing what the transaction actually was, which can uncover any errors that may have occurred.
A debit is an accounting owing record which is recorded on the left-hand side of a journal. A credit is the ability to obtain funds which is recorded on the right-hand side of a journal. The basic accounting equation is assets equals liabilities plus owner's equity. This is then extended to a larger equation of assets plus expenses plus drawings equals liabilities plus owner's equity plus income. Assets, expenses and drawings are always debited and therefore written on the left-hand side of a ledger. Liabilities, owner's equity, and income are always credited and therefore written on the right side. For assets and expenses and drawings, they will all increase debits and decrease credits, whereas liabilities, owner's equity, and income will always increase credits and decrease debits. If the total amount of debit is bigger than the credit, the account is said to be a debit balance. In comparison, if the total amount of credit is bigger than the debit, the account is said to be a credited balance.
The ledger account is accounts with individual accounting records of increases and decreases of an item. All items, assets, liabilities, owner's equity, expenses and income accounts have their own separate ledger account. These accounts are posted from the general journal to the ledger accounts with their own post-reference number, which enable users to easily access the single account from the general journal. These accounts can have either a T formation, which both debit side and credit side will balance, or a columnar format, which is a more detailed entry giving the date, details, debit amount, credit amount, and the existing balance for each entry. The ledger account can either be balanced or footed at the end of the month, or the end of the reporting period. Balancing is a formal process of finding the closing balance and carrying it down to the next month for the next period. And footing is finding the balance on the appropriate side of the account and writing it in and circling the final balance, which is a more informal process as opposed to balancing. My new small business commenced trading last week, and I made sure that I wrote it down on a piece of paper, all the details about the transactions that occurred, but it's not a proper system.
It's alright, I'll teach you some accounting.
Oh, yes!